Greetings once again, and thank you for joining us, my dear friends. Thank you for your support. Thank you for being with us throughout our previous episode. This is our 6th episode talking about the financial literacy, and it is brought to you by the Financial Literacy Foundation, where I come from. I'm a financial planner. I'm also a tax consultant. I'm also an authorized accountant, by the way. Today, we are continuing from last week's episode where we talked about investing right in order to get results. Today, I want to add a little bit with regard to investing right to get results, but also looking into the estate planning implications of our investment. We are still on having understanding of investing right. Thank you very much. And before we continue, allow me please to give thanks to my senior pastor, Pastor Joylene, and our general overseer, Pastor Strike, who created this platform. It is not obvious, it is not necessary, but through their leadership and their guidance, mentorship, we are able to come to you. We are able to come to your lives today. And thank you very much, my spiritual parents, in creating such a platform. Matimela Investments is an authorized financial services provider, which we are authorized to give advice. But let's understand this. This is not considered an advice. It is a general discussion that we can have. So this is not a financial planning advice as defined by the relevant acts. Why are we talking today? We want to see that we can be able to invest and invest right to get results. And we spoke last week about 5 aspects, among other things, that we need to bear in mind in order to bear good results. And we spoke about tax to say every financial services product or every investment product has got a tax element into it. You get taxed. And the other aspect was liquidity. How liquid is my investment? And the third aspect was risk. What is the risk implication of my investment or the product that I've come into? And the fourth element was cost. What are the cost elements associated with the product that I'm having? And the last one was time. What is the time required in order for me to be able to get the good results as purposed by this particular investment vehicle? These 5 aspects, friends, are always playing a role in your choice or in your determination of which type of investment vehicle can I use. Very important. You miss any of these things, you might be using the right product, but you get the wrong results. Yes, you might be using an investment vehicle which you are hoping to get so much return, and you find that the product is able to give you such, but the end game when the money is in your hands has to do with the tax, and it is reduced by the tax amount that you have to pay to SARS. So this is very important. So we started off last week talking about endowments. And 2 major aspects that we spoke about with endowments. It's with regard to the tax aspect of it. And we said it is taxed based on the 5-fund approach, where 30% of the fund is taxed. So the money might be getting into your hands tax-free, but the money, while it was still in the fund, it was being taxed 30%. That's not a simple figure. And we did say that anyone who is below the 30% tax bracket, this product might not be the best, given the 30% tax element of it. And there are other things that we spoke about when we spoke about the fact that in terms of liquidity, you can only be allowed to access your money only twice in the first 5 years, not more than that. And you cannot increase or decrease your investment. So both increase and decrease. You cannot do that by more than 20%. Sometimes when we come to experience with these things, we say this institution is funny, but we did not get a good understanding on how this particular investment works. That is why we are spending our time talking about these aspects. Today, I want us to look further on other investment vehicles. And today, maybe there's 2 or 3, given the time that we can look at. And number 1 for today, I want to talk about the tax-free investment plans. We also talk to them saying it's a tax savings plans. This type of investments, the tax-free savings plans, is only available to natural persons. So in other words, you cannot come as a company and buy a tax-free investment plan. It's only available to natural persons. We must also understand that it can be included as a deemed property in your estate in the event of death. Yes. So we don't choose investment vehicles just for the sake to say, I choose this one and it's going to work well for me. We must also consider what happened to this investment in the event of my death. That is why I choose to relate to this as to how will it be treated in the event of my death. It is a deemed property. So tax-free savings plans is a deemed property in your estate. Like the endowments that we spoke about previously. When you did not nominate a beneficiary, it is a deemed property in your estate. When you have nominated a beneficiary, it will be payable into the beneficiary or beneficiaries nominated. Very important aspect in deciding your investment strategy. Well, you cannot deduct the premiums or the contributions that you make annually into the tax-free savings plans. So they are free from tax. So as much as they are free from dividends tax, they are free from a capital gains tax. So tax-free investment plans, they are not liable for capital gains tax. They are not liable for dividends tax. They are not liable for income tax. And they can come in different ways. You can find them in a bank. You can find them in a cooperative banks. You can find them in a long-term insurer. We talk of insurance companies. And you can find them in a national treasury. And you can find them as at any authorized user as defined by the Financial Markets Act. So even in an institution that is authorized. So in other words, there are other institutions that are not authorized to give you tax-free investment plans. Law is very important, guys, in order to be able to understand your investment strategy. You can only contribute up to 36,000 Rand per annum. So, which means per month, divide 36,000 Rand by 12. That is the maximum you can contribute. You are allowed to contribute less than that, but you are not allowed to contribute more than 36,000 Rand per annum without tax. So you can contribute 40,000, 50,000 or whatever amount into a tax-free investment plan, but the amount beyond 36,000 per annum will be, you guess right, it will be taxed. And the tax is whooping because it is 40%. So if you contribute 40,000 per annum, that means it is 4,000 Rand beyond the 36,000 Rand tax-free allowable. So that 4,000 will be taxed at 40%. So only the 4,000 will be taxed at 40%. So we need to understand that it is important to adhere to the limitations in order to enjoy the tax benefit. Yes, it is true. You can be able to contribute more than that. How can you do that? My recommendation will be put it in the name of another family member. So a parent can contribute more than 36,000 by putting in the additional amount in the name of the child. So if we are a family of 5, we can contribute 36,000 rand times 5. Even if the contribution comes from the same person, we are not counting the contribution per contributor. We are counting contribution per the owner of the investment account. So what are you waiting for? Put that money in the name of your child. Put that money in the name of your spouse. Put that money in the name of any other person, as long as it is within the 36,000 rand annual limit. And you have only up to 500,000 rand per annum. So beyond 500,000 rand, it will be taxed. You will realize that it becomes more than 36,000 rand per annum. So it doesn't become a tax desirable product if you contribute more than the tax allowable limits. So there is nothing stopping us, friends, in order to save. When we say tax-free, we are saying that it is not taxed either in your hands and it is not taxed while the money is still in the fund. Remember, endowments are taxed not in your hand, but they are taxed while the money is in the fund. So it doesn't matter whether you personally have paid to SARS. What matters is your money. You are sharing it with SARS. So tax-free investment, you are not sharing your money with anyone when you are sticking into the limit. Let's quickly look at the second vehicle. And these are the bank products. Generally, the bank products, we are familiar with fixed deposits. Fixed deposit is just one of the bank products. And by bank products, I'm not referring to the names of the product that that particular bank is using, because the names and the design of every other product is governed by the limits of how can that product be designed. We generally have 3 types of products in a bank for investment purposes. We've got call deposits, and we've got notice deposit, and we've got fixed deposit. Call deposits, these are investment vehicles which you have immediate access to the funds, and you have to maintain a particular minimum balance in order to keep the investment going. Notice deposits, you get interest rates paying a little bit higher than the call deposits, and you have to give notice in order to access your money. You must keep a minimum deposit also. Fixed deposits, which is the third bank product, as the name say, you have to fix your money for a particular period, and the interest rate is a little bit higher compared to the previous 2. But there are penalties that you pay in order to access your money, should you want to access your money before that notice expires. Tax. What are the tax implications? Let us remember one thing, and I hear many people saying that I've invested in a 32-day notice. My friend, you're joking. Because the returns that you get are taxable. Many people are owing SARS and keep on paying SARS on an annual basis, and they don't know where it's coming from, because my employer had been deducting the tax from my salary. I can't understand why. Let me tell you why. Because you have been earning interest in a bank, and interest is taxable by its nature. Only the first 23,800 per annum will be tax-free. The balance will be taxed at your marginal tax rate. So if you are a 30% taxpayer, remember that 100,000 rand earned from the bank, only the first 23,800 will be tax-free. The balance, remove your 30% tax from it. And at the end, you're going to find that actually your investment did not do well. Lastly, with regard to the bank investments or the bank product, is that you can hardly beat inflation. In fact, let's put it clearly. You will never beat inflation. South Africa today, inflation, we are looking at a rate between 5 and 6%. Now, when you get 5% in a bank, you first have to deduct your tax rate out of that 5% in order to be able to determine the real return. Don't be fooled by the nominal return that your bank is promising you. We talk of real return, and real return we are referring to when we have discounted the nominal return by the tax that you pay, by the inflation that has eaten up your investment. Very important. The last investment vehicle that we will talk about today is the collective investment scheme. We also call it unit trust. So CIS, collective investment scheme, not the other CIS. Collective investment scheme, it's also referred to as unit trust. Now, how do unit trust compare with the banks and with the endowments? Number one, unit trust, there is no fixed term. You can put your money in and you can have your money out at any given moment of your investment. Remember 5 elements: time, cost, interest, tax, and the others. Now, these ones, they become real even when we look at the unit trust, because with regard to unit trust, the time issue, the best of it is that you can put as long as you can without anyone questioning you. You can put as little time as you can without anyone questioning you. With regard to the tax aspect of it, returns on unit trust are not taxed in the fund. They are taxed in your hands. And what tax is that? It is not income tax like we see in bank products. Bank products, you pay income tax. With collective investment schemes or unit trust, you pay capital gains tax. And capital gains tax is a little bit more favorable compared to income tax. Income tax is a flat rate based on your income tax bracket. But capital gains tax, we have to do a little calculation in order to arrive at your taxable capital gain. There are exclusions in the process. So at the end of the day, for the same amount of return, say 100,000 like we used in the previous example, with capital gains tax, you may pay a much lower tax to SARS. Whereas with bank products, the same 100,000, you will pay a little bit higher tax on that return. So unit trust, there's no term. It's favorable from the tax point of view. It is also ideal even for lower income tax bracket payers. That is when we compare it with the other vehicles. So let us bear in mind, friends, to invest and get results, you need to understand the tax aspect of your investment. And with unit trust, there are no charges when you make withdrawals. There are no charges when you make changes in your investment. So also, you can make additional contributions as and when you have additional funds. You may be a person who's got some additional income, which you are not using that money at that particular moment. Put it in your unit trust. No one questions you, why are you putting more than 20%? Remember, with the endowments, when you put more than 20%, not that you will not be allowed, but you are violating one of the rules. And the result of that violation is that the term of your investment will be extended by the period from the start to the date of violation. So if you violate in year 3, we're going to add the 3 years at the end of your original investment term. So a 5-year investment end up being an 8-year investment. Now with unit trust, there is no such. You can put your money now and come back after 3 months and you get your money. And the other aspect, like we said, with bank deposits, you can't beat inflation. But with unit trust, you are in a position to can select proper funds that can be aligned with your investment strategy. With bank deposits, you can't align anything with anything. You get it as given to you. Whether you are of this tax bracket, whether you are of this risk acumen, it still stays the same. So let us bear in mind that your investment vehicle must correspond with your personal attributes, with your personal circumstances, be it your tax bracket. So if you go into endowments while you are on an 18% taxpayer bracket, my friend, think twice. Yes, if you are on a 45% tax bracket, maybe endowment might be ideal because it is taxed at 30%. Maybe some other form which are below, and if you are at a 45%, there's nothing more than that. So let us be careful, friends. You can use the right vehicle, but finding that you are a wrong investor for that particular right vehicle. So investment vehicle must respond or correspond with your personal circumstances. I hope that is clear. Now, can we come to a close, given time that we cannot deal with other aspects? I would have loved that we look at other investment vehicles like shares. Many people talk about shares and we don't understand what is it all about. By the way, when you go into unit trust, the bulk of your unit trust investment is invested in shares. So don't cry and wish to put your money in shares if you are on unit trust, because you are already in shares. But also, maybe to close off the shares issues, when you want to invest in shares, you must be able to understand how to analyze financial statements. You need to be able to understand what is earnings ratio, earnings per share. And you need, if you can't do that, you must be able and prepared to pay someone, a specialist like myself, who can be able to assist you in understanding the analysis. If not, please, there's nothing wrong in sticking to things that you understand better. Allow me to close, friends. And I want to close with COVID work or homework. And you know, and I believe and I hope that you are dealing with the homeworks that I've been giving you throughout. Today is the 6th episode, and I've given you, this will be the 6th homework. And with these homeworks, it is my desire that you will be able to sit down and reflect and look at your financial strategy. And question number 1 to you today is that, do you have an investment plan? Do you have an investment strategy? What is your long-term wealth creation strategy? You will answer me on that. Question number 2. When last have you reviewed your investment strategy? Is your investment strategy in line with the current economic circumstances or the current economic challenges? And the last question is your strategy in line with your estate planning strategy? Or is it in line with your estate planning goals or your wishes? Remember, you are not a stone. You will die one day and you may have to leave your investment behind. What strategy have you put in place? It's your investment strategy responding to such kind of circumstances. And if you are not sure of the answers on the questions I've raised, please feel free. Can you see the numbers on the screen? Write it down quickly. Give us a call. We will help you in understanding some of these things. And I promise you, and I know that Pastor Strike is listening in, so I can't lie before Pastor Strike. We will not charge you a cent in order to assist you to be able to understand and to be able to help you the estate planning implications with regard to the current strategy that you are in or the current vehicle that you are in. The ball is in your hands, my friend. It is up to you to make the right decision. God has entrusted you with the funds that you're having. It is still His money. It's God's money. He has trusted you to manage it. So manage it well. I know that you are a great steward. Where you are lacking a bit, I know that you will upskill yourself to become the great steward who can be trusted with the little in order to receive the much from our Almighty Lord. I thank you very much. Thank you for tuning in, and I bless you and have a great investment strategy in place. Thank you. God bless you.